Equities have recovered from their 2025 lows as the worst-case scenario for trade tariffs appears to have been avoided, while hopes of trade deals lift the mood. However, sentiment remains fragile and uncertainty high. I'm Fiona Cincotta at StoneX, and to discuss this and more, I'm joined by Global Head of Retail Dealing, Alex Ridges. Hi, Alex. Thank you for joining us. So what's the general outlook for equities then?
Well, we've almost got what's happening in the markets and sentiment. So market reality versus sentiment. Market reality has actually been quite positive. You know, if you look at the markets, if you took a snapshot of the last 2 weeks, you say, wow, there's a lot of optimism. And we've seen that driven this week, particularly by the China rate cut, again, just sort of being able to fuel the world economy. But then when we look at sentiment, again, there's still that sort of permanent negativity, which I suppose there's a reason to be. I thought it was very interesting this week that there was one of the CEOs of a major German company that's in the DAX. He even used the term guesstimate. You know, guesstimate's just something that CEOs never use. But I almost admire him for saying, sort of using the term guesstimate, because like a lot of other CEOs, they're all having to acknowledge this uncertainty. You know, just saying, well, we don't know. And you know, if in their sort of quarterly reports, companies aren't actually saying we expect a downturn, you know, or there could be a downturn, you know, it'd be remiss of them. You know, investors would be like, well, come on, why did you not spot this? Why did you not see this? But that idea of the guesstimate is no one really knows what's coming. So from that perspective, you know, there's still caution. And
I mean, uncertainty of the long-term impacts from Trump's trade tariffs. I mean, that is really bad, though. Well,
the only thing I think in this scenario is, okay, we're only a month in since Trump's sort of announcements, but maybe, you know, there's that idea of, you know, there's no smoke without fire. We haven't seen a lot of smoke, if you sort of mean. So in some ways, that uncertainty, there isn't any definitive proof that there is going to be a downturn. You know, when we talk of the slight dip in US growth, we know why that was. That was because a lot of US companies, they stockpiled, they almost their costs went up as they bought in produce and items or whatever. But actually their sales will come from that in the future. So that was a timing issue. So in some way, uncertainty means we haven't seen any bad. So maybe uncertainty is a good thing.
Yeah, completely. Because that's a really good point there, is that contradiction as well between the soft data and the hard data. We're seeing it a little bit more in that soft data, but not quite so where it's not come through yet in the hard data.
Yes, exactly.
Complete. And what about the central banks then? I mean, what's the current central bank sentiment?
Well, if you look at the BOE, we've had almost that scenario post-COVID where they were too late to raise rates when they should have done earlier. All right, that's hindsight, but I think everyone was in agreement. You know, it was pretty. It's hindsight to fact that they did a pretty bad job. So we're in this scenario where we're always going to be too late to then cut rates subsequently, because if they were too late to raise, which they were, if they cut too early, the whole market's going to look at them and go, well, come on. Fool me once, don't fool me twice. You know, you've made the same mistake twice. So there was almost going to be that stubbornness in reducing rates. But what Trump has given them is that this sort of global groupthink. You know, if we relate back to the CEO, this idea that everyone's expecting things to be bad, therefore it's like a get out of jail free card for the BOE to go, well, look, now we've got an excuse to cut rates. We can actually cut rates without looking weak. So let's do so.
And do you think the rate cuts will continue at this current pace?
Well, we saw today with the BOE rate decision, of course, we saw a quarter point cut. The surprise was that two members decided, again, against the cut, said, no, we should keep rates on hold. And again, this goes back to what I was just saying, that idea of stubbornness, that central banks, central bankers, they're never of the view, oh, let's try it. If it doesn't work, we can always reduce it. I don't that could be called playing with your economy. But they're very much reactive to what's going on. And I think from that perspective, their reaction is, well, look, we're not reacting because nothing's happened yet. So this is where we've seen rate cuts, and I think traders are still predicting a couple more cuts. Almost, I think it's like 2.8 more cuts even after today, before the end of the year, and just under 3 rate cuts in the US. But I wouldn't be surprised if that was a bit, seen a bit excessive, a bit on the dovish side, because again of that stubbornness, and that they've got to react to what they see in the markets from growth. And that actually hasn't been that bad yet.
Yeah. And we've spoken here about the BOE. Let's turn our attention to the Fed. So the Fed rate decision, they actually left rates on hold. What is the Fed saying?
Well, Jerome Powell is almost agreeing with the two members today, or they're agreeing with him. We haven't seen any reason to cut rates. So he's not cutting rates. And I think particularly for Powell, the chairman of the Fed, it's very much the case of, I can't cut rates because then I'm seen as weak. Then it's Donald Trump bullying me and I've caved in. And I think, again, he used we talked about it a lot, he used the term certainty. I think he wants certainty that there is going to be a downturn before making cuts. And again, his comments didn't seem to affect market sentiment on how many rate cuts there would be. But it's another sign, just, from at least from my perspective, that the predicted rate cuts may be overdone. We're on hold at the moment.
Yeah. And the other thing that was interesting about that Fed meeting, I think, was the fact that they see potential for higher inflation and higher unemployment, which is obviously a contradiction in that dual mandate, or makes it very difficult for the Fed with that dual mandate that they...
Yes, exactly. And again, this is idea, that idea, if it ain't broke, don't fix it.
Yeah.
If they change these, they drop rates, then there is high inflation. Yeah. There's going to be big problems for them, Yeah.
Completely. And so what does all this mean for equity investors then?
Well, we've seen uncertainty, ties very closely in with recession, or at least the fear of recession. And again, over recent weeks, we've seen the sort of percentage chance as calculated by various metrics of recession rising, but still, still below 50%. But I think when you're talking about what does this mean for investors, recession isn't necessarily a bad thing.
Okay, so recession isn't bad. Explain that to me.
Yeah, I know it's a difficult concept. It's obvious recession bad, growth good. But normally, when we look at past recessions historically, the market move happens before the recession. There are very smart traders, there are hedge funders with teams of researchers all looking at those minute details, trying to spot the downturn before it's in the more widely available data and the common data and in the news. So even before sort of Trump's tariff day, we already saw a significant decline in the Nasdaq, from over 22,000 down to around 20,000 where we sit now. So in this sense, when, again, talking about historically, normally the market's moving before we see the recession, and then recessions are actually a good point to buy because the market moves happened.
So what can traders take away from this then?
Well, I think this idea of timing, or I suppose probably a better way to put it is chronology. When investors are looking now, the common thought is recession is bad, but actually, by the time we're talking about recession, markets have already fallen. So I think when investors are looking at news, rather than go, this news is bad and news is going to drive the markets, it's almost like the markets have moved, which has caused people to assess what's going on. And now the idea of recession is sort of coming into people's minds, is being realized. So in that way, the chronology is the markets have moved, now the news is happening. And so I think when any sort of news or data point comes out, it's that idea of saying, is the chronology, has this move already happened? In which case, there's no point trading the news because it's done. It is almost the best thing you can do is do the opposite. Again, the opposite is exactly buying in times of recession. Again, because rates drop, it helps everyone. So I think it's that idea of chronology. Has this move already happened from this news, or is this news going to drive future moves?
Excellent. Well, thank you very much for your analysis, Alex. For more videos like this, please do like and subscribe.